Alright, so in the last few sessions you've learned about key reference areas, which are the most important ones, and how to interpret price behavior at them. After that, we delved into a top-down approach of looking at the markets from multiple time frames to give you a deeper look into what's really going on, and to help you avoid looking at things in isolation. Now we're going to tie those things together. We're going to take the key reference areas, all that you learned, and tie it into the top-down multiple time frame approach to give you a contextual understanding of the markets, to allow you to interpret price action and market behavior at key reference points from a contextual point of view. What we did to start was teach you things in isolation. So the key reference areas was mostly taught in terms of each one by itself, so you could absorb the principles deeply and understand things at their essence in a somewhat uncomplicated way. Now that you understand the foundations, we're going to tie them together and show you how you should truly analyze the markets in a contextual manner. And that's what it's all about. It's all about context. This session is all about that, and it's going to prove very powerful for your market analysis skills. So let's get focused and jump right into the charts. Okay, so here we are in the charts. And the question I want to pose to you is, how do you know how much importance to give to any specific key reference area? We've talked about four major different ones, but how do you know when to give any specific one extra weight, to pay more attention to it, and to draw more important conclusions from whatever happens there? Because so far we've talked about how you interpret price action and market behavior at key reference areas and what that may mean going forward. But if you really want to trade the markets well, if you want to be able to analyze them correctly and actually profit from them, you also have to form a different skill. And that's the skill of anticipating what's likely to happen at a given reference area based on context. Okay, so at first we looked at things in isolation, and you looked at each key reference area and you were seeing how to interpret market action there. But when you're trading the markets, you have to be looking forward. And you have to be making discretionary judgments about what's likely to happen based on context. You're not forecasting things and trying to be right. That's not what it's all about. It's about odds and scenarios, thinking in what if statements, and drawing scenarios about what's likely to happen once we reach a given key reference area and how important that key reference area is based on context. And the context, in turn, we get from our multiple time frame analysis. So now we see how it fits together. We take our multiple time frame analysis, we get the background context of the market. Using that background context, we're able to anticipate which are going to be the more important reference areas and what's the market likely to do at those key reference areas based on this context. And then no matter what happens there, we get information. If the common thing happens, that's information that things are playing out as expected. And if the uncommon thing happens, we get information that maybe we have to change our view about the context because things could be changing. So let's take an example right here based on what's in front of us on the charts. Okay, I've zoomed it in just a bit here so this can be more clear to you. If we were trading this day right here, okay, so right now we're currently in this day, and this is our previous few days, 1, 2, 3, 4, 5 days of previous market action. Alright, what would we be thinking looking forward? Where would we be drawing our major key reference areas? And what would we be thinking about them and anticipating to happen at those places given this contextual view? Now I'm not going to zoom out to the biggest time frame. I want to make this point just from looking at even this time frame's contextual view first. So pause this video for a bit and just take a look at this chart and see where you would place the major key reference areas and what you would be thinking is going to happen once we reach them in terms of what if scenarios. What's the most likely to happen in terms of odds, and if the opposite were to happen, what would you be thinking? So go ahead, pause this video, think about it, and then we'll continue. Okay, so hopefully you've thought about things a bit, because that's how you're going to learn the most. But either way, here's what our analysis would be. The first thing when we take a look at this chart, right, when we're thinking in terms of contextual view of how to put the key reference areas into context and then be able to anticipate what's likely to happen there, as we look at what's the trend of the market or what's the balance if it's not trending, right? So just from looking at this chart, here's what I would do. First, I would take a look and see, okay, well, obviously we had a major balance area right here. So I would just take this, I would draw a profile right over it. All right, here we go. And this is where the balance area ended before that breakdown began. Let's move it just a little bit more here to the left. Okay. And so this is our balance area. It was a 4-day balance area. And here's where the majority of the volume took place, to the lower end of the balance area, right? And here's another key reference area. This is where the directional conviction started, the big bar down that just took off on high volume down here and then just kept it going. And this was the breakout out of this key reference area, out of this balance, right? That's number 2. Number 3 is the bottom of this balance area, right? The previous supports 1, 2, 3, 4, 5 times we bounced here. So this would be another now key reference area. Number 4 is the mini balance that happened after we broke out right here. And then now we are in a balance area right here. So here we could also draw a little profile, all right, of where this thing started and ended right here. So it's just a small little balance area, but nonetheless, since we're looking only at the day time frame, this is small, but it was just yesterday, so it's going to be a relatively important area too. So those are several key reference areas that we have right now. So now what would we be expecting if the market were to go back and test these different reference areas? What would we be anticipating? It's not just about looking at what happens there. It's about thinking forward and thinking, if it went there, what do I think would happen? Not just based on my guess, but based on market principles and everything I've learned about the markets. And so our analysis would be that the market was in a 5-day balance. It broke out with aggressive sellers, initiative activity to the downside, right? And it quickly built value below this major value area. This is showing that prices are getting accepted below the previous value, at least momentarily, right? And then once we broke down even further, also on good volume, and bounced here, so now we would be potentially able to also draw a running profile because this thing, we're still in the midst of it. It's not completed yet, but a running profile. We're also building value here, and value is migrating lower. All this is what is showing that this original breakout was legitimate. Sellers are in control of this market, and it's also showing that now, even though we were balancing here, in this time frame we are in a downtrend. So the context now, the way we look at it, is we are trending down after breaking out of this major balance area. Everything is confirming. We're getting high volume on the pushes down. We're getting nice directional conviction. The sellers are in control, and they're building value lower and lower. All right, so now we think, first, if the market were to come and retest this area, okay, this previous balance, the first thing we would be thinking is that sellers should be active here again. Here was an area that was an equilibrium point between sellers and buyers, but then sellers pushed it down through here, believing that value is lower. If this downtrend is still intact, and if the sellers are still quite aggressive, once they retest this first key reference area, right? If they're still quite aggressive, this should be the first place where we head back down. So I wouldn't be thinking that, hey, let's just see what happens here. I will be proactively expecting a push down here on the basis of this context, right? On the basis that when a trend starts, especially in its beginning after breaking out of a 5-day balance area, it's more likely to continue than to reverse, right? And if it's going to continue, this is the first logical place where it would hit resistance and new sellers would come in, the old buyers that were at losses would be selling, and we would push back down. That's the first thing I'd be thinking, right? But I would also notice that this is a relatively smaller balance area. So if we were to break through it, okay, this would not invalidate the whole down move. This could be just a bigger pullback within this bigger trend down, right? So if we did break through this to the upside, it would be telling me, okay, maybe they're not aggressive as I thought for the time being on this time frame, but I would zoom out and still see that the major key reference area is this one, right? And that we are still below it, all right? So then what I would expect is, okay, next key reference area. If it were to now to test the bottom of this key reference area, the bottom of this previous balance, I would expect selling there. I would expect that to hold. That is the most likely thing to happen given this context. There's going to be a lot of trapped buyers that were buying in these lows, and some of them that were a bit longer term that hadn't exited on this push down. And now once we come back here, that's going to be a good place to exit. Previous support becomes resistance, so I would definitely be expecting sellers to enter in this area. All right? Now, next thing, so that would be the likely thing to happen. Most likely you would get a reaction here and we drop back down, potentially go back to new lows as the bigger picture takes hold and continues, right? But let's assume, again, we always have to be thinking what ifs. Let's assume the buyers, for whatever reason, maybe, sellers pushed it down, they got short very quickly, and they just met a major wall of buyers here despite this context, and now they're pushing it higher, right? And so I would be looking at this general area. I'll be looking at the high volume node here and the place where directional conviction pushed down. And this is the last stand for the bears, the last stand for the sellers. Now, I would, again, even though we had taken this out and taken this out, I would still be expecting these two places to hold. I wouldn't be as confident with the sellers anymore because we had taken this out to the upside and we had broken through this. I would be a little weary, but I would still be giving the bigger picture context the upper hand. And this would be the last stand of the sellers. If we were able to hold this high volume node and place of initiative activity downwards, this launching point. If we're able to hold it, which would be the expectation, then the reaction down is likely to occur. Now, if not, this whole downtrend context is broken. It's invalidated, and now I would be expecting a push all the way through to the other side, potentially. To the upside. It would have been like, okay, fine. Sellers were aggressive, they pushed it down, but instead of continuing down, which would be normal after this major breakout, and after all this acceptance, they quickly got rejected by the buyers. Responsive buyers came in, responded to these lower prices aggressively, and pushed it through one key reference area, through two, and now pushing it through these major ones, you would expect price to shoot through to the other side and be higher. But until that happens, the way you look at things contextually is to give the favor to the bears, to give the favor to the short side because of this picture. And so you would be anticipating sellers here and anticipating sellers here, and that would be the highest odds thing. And if you were trading it, which we're not getting into strategy and tactics yet, but you would be setting up a short right here. This would be a very logical, high odds short to take place. And then if this one broke through, you would be setting up another one here. Right? Until those things are invalidated, because most of the time they're going to work. And this is how you look at key reference areas contextually. Now, in reality, what ended up happening is that the bears were strong enough and aggressive enough that we didn't even get retests of these. We just kept tanking down and down. So they really proved the bearishness, and this was indeed a legitimate down move. Okay, let's talk about the flip side of things now. When are certain key reference areas not that important? Alright, so let's take a look at this, for example. We're here. We've been trending up nicely. We had a little balance area and we pushed away from it to the downside. So let's just draw that in right now. So we're in this current day. We're still in this day, and We pushed up, we had this half day balance area and broke down out of it to the downside, right? Which is for the momentary on this little time frame, this is bearish, right? So now if we were to retest this key reference area back up, how important would that be? And what would we expect to happen there? Well, just from this limited perspective, again, you would have to be doing a much more top-down approach to seeing this, but just again to explain these things from a simple context in the beginning, if this was a strong uptrend that just started and it hasn't shown any sign of exhaustion or crazy buying coming in to provide some sort of climax, nor a 2 or 3 day balance to potentially be ending it, the expectation would be that we're going to have some kind of normal pullback, and it can be lower. Doesn't have to be just to here. It could extend quite a bit down, but that this key reference area is not that important. Why? Because here we're looking at it as resistance, but in the context of an uptrend. All right. Before, when we were looking at the high volume area in the previous example, it was in the context of a downtrend. And so when we came back to test it from below, right, it was a downtrending move, so we expected heavy resistance there and a push down. Here it's in the context of an uptrend. So logically speaking, we would be expecting this to test it, maybe have a little reaction down, but overall we would expect to push through this to the upside. So we would not be looking at this as a very important resistance area. Maybe we would be looking at it as a point of information to show us how strong the buyers currently are. If we weren't able to break through it right away, maybe we'd start expecting that we're going to be balancing sideways before we continue to push higher. But the major expectation would be that this thing is not going to hold much before we break through it to the upside based on this overall uptrend. And so looking at what happened next, we see that indeed we just pushed up right through it, barely even bounced, and then just shot right up. Okay? And it's the same when we're looking at a downtrend. Now we've moved to another chart, right? So the market in this case was moving down, trending down pretty heavily. Here they gapped up to the upside, looked like they were going to reverse this, and then just kept tanking straight down, down, down. All right? But here we see a rejection, right? We see a buying tail and a rejection of lower prices that was pretty sharp, right? We tried to test it down and we kept pushing higher. All right. So now looking at this, obviously in this day this was bullish. This was a nice sharp rejection, whereas the previous years just kept going down and down. This was a nice rejection higher. So is this a very important key reference point? Is this going to become a very important support? That's what you have to be asking yourself. Well, it depends on the context again. If this downtrend, right, had just started from some kind of a breakdown of a big balance or something, then the likelihood, unless we had reached some kind of major climax or sentiment extreme or anything like that, the odds and the likelihood are that the trend will continue. Now, if this had come after 2 months of straight down movement, and then this had been massive volume to the downside showing climax, then maybe this would become more important. Again, it's contextual. But just seeing 4 or 5 days of down movement, and the assumption here, we're not going to look at the bigger context of the move, but just in this, right? The assumption here has been only 4 days down, nothing major to cause a climax, right? So despite this being a bullish thing, a buying tail that we had discussed before, in the context of this downtrend, it's not that important. In the context of this downtrend, what we would expect and what we'd be anticipating based on the odds is that on a test down, yes, we may get a bounce, but the bounce is probably only going to be temporary, and eventually we're going to break through this low, break through this support area, because the bigger picture is that the sellers are in control. Here it was only momentary buying that put the buyers in control of this day. But this day is only one part of a much bigger picture, right? And so let's look at what happened. The next day we gapped down. We tested this area. We're having small bounces, right? And then we just kept tanking right through it. All right? And so, again, this isn't some kind of magic forecasting or anything. It's simply looking at the odds based on the context. The context is a strong trending down move. There hasn't been any major climax. This was just, a decent sized buying tail, right? Since it's a bigger downtrend, we would expect it maybe only to hold temporarily and then prices to break through. Now, if it does hold and cause a very sharp move to the upside, that also gives us information that maybe this down move, this downtrend is ending, right? But you always have to go with what's most likely. Now, if the opposite happens, that gives you great information. Now, contrast this buying tail, right? And it's important. If this had come in the context of an uptrend, if we were trending up here like this, then we hit this buying tail. This would be much more important support. If we drop down, then we would be expecting prices to bounce from here. Let's take a look at an example of that. Okay, now we're looking at an opposite scenario where the market was trending upwards, right? And within this upward trend that had started from before, it's just not showing up on this chart, we get a nice buying tail. We had gapped up, sellers took control, tried to push it down, the buyers rejected it and just pushed it way higher and formed this nice buying tail, right? Now, the next day when we tested this buying tail, we got nice buying, right? But we didn't really have to wait until this happened to anticipate what the highest odds scenario was going to be. And because the context was an uptrend, the highest odds scenario is that this key reference area is most likely to hold, right? Before, the buying tail came in the context of a downtrend, it was most likely to not hold. Now it's coming in the context of an uptrend, it's most likely to hold, so we place more weight on it. We give it more importance. And so as this thing is coming down, we expect this area to hold if the uptrend on this time frame is still intact. And if this thing were just to tank right through this key reference area and hold and build value lower, well, again, this would be giving us good information that maybe this uptrend is coming to an end, at least on this time frame.